The White House says 88% of Social Security beneficiaries won't pay taxes on their benefits under the new bill. But here's the truth. That's not what's really happening. And if you rely on Social Security, this can mean big surprises for your 2025 tax bill. So listen to this. This is going to be crucial, and no one in Washington is really spelling out it clearly what it means for seniors. And in this video, I'm pulling back the curtain on what the White House memo that dropped July 1st is mentioning. And we're going to be talking about the real meaning behind that 88% figure, why this isn't a repeal of Social Security taxation, and a 4-year tax window you need to plan for starting in 2025. And before you think you're safe from paying tax on your benefits, you'll want to watch this all the way to the end. I promise you the details will change how you plan your retirement income and strategy. So now let's talk about this headline everyone's sharing because it sounds almost too good to be true. According to the White House Economic Council of Advisors, 88% of Social Security beneficiaries will no longer pay taxes on their benefits under this reconciliation bill. And at first glance, you probably thought, finally, after all these years, Washington is listening. No more taxes on Social Security benefits. But here's the truth, and you won't hear this on the evening news. The bottom line is that this is not a repeal of Social Security taxation. It's not even close to that. So let me break it down with real numbers because that's where the truth lies. Here's what this bill actually does. It adds a new $6,000 deduction per senior stacked on top of the standard deduction you already got. So if you're a single filer, your total deduction jumps up to $21,000. The average Social Security check works out to about $2,000 per month or about $24,000 per year. So you subtract those deductions and suddenly only a tiny fraction of your income is taxable, maybe even zero, depending on your other income sources. So yes, according to the math, 88% of beneficiaries will no longer pay tax on Social Security for now. But notice what word I'm using here, the threshold, all right? So you're not exempt from the law that taxes Social Security benefits. That law hasn't changed. This isn't a repeal, so the IRS hasn't packed up and gone home. What they've done is simply raise the bar on how much income gets taxed temporarily, which helps a couple of retirees, or actually many retirees, honestly. And it's like someone telling you, don't worry, we lowered the height of the hurdle, but the hurdle's still there. And it can go right back up in a few years, and that's where most headlines stop talking about this. And they give you a feel-good story, but they skip the fine print that could hit your wallet later. And that fine print is exactly what I'm going to be talking about next. Now, here's the scary part, and I need you to really hear this. It's the fine print nobody's talking about. That $6,000 bonus deduction they're celebrating, it's not going to be permanent. It's only going to last for 4 years. So it's going to be for 2025, 2026, 2027, and 2028. Come January 2029, unless Congress decides to extend or make this permanent, this deduction is going to vanish overnight. So let's picture this. You plan your retirement around this rule. You breathe a sigh of relief thinking finally no more taxes on Social Security benefits. You budget your spending, you take the vacation, you help your grandkids with college money, all assuming this tax break is here to stay. Then 4 years later, boom, the deduction disappears. Suddenly, thousands of dollars of your Social Security income are taxable again, adding a surprise bill to your already stretched retirement budget. And let's be honest, Congress doesn't exactly have a great track record of making temporary tax relief permanent, do they? So this is not guaranteed. It's a short-term patch, and if you're not planning ahead, you could be setting yourself up for a tax trap in 2029. And bottom line is that you can't afford to treat this as a forever solution. Think of it as a 4-year opportunity, but not a permanent fix. Now let's call this what it really is. It's a temporary tax deduction, not a repeal of Social Security taxation. So if you're hearing politicians say things like, we ended taxes on Social Security, well, please understand that is a misleading headline. They didn't change the law that taxes Social Security benefits. The IRS hasn't retired from collecting money from Social Security. It's just taking a short vacation for certain retirees. So here's how it actually breaks down. So if you're single and you earn under 75,000, or if you're married and earn under 150,000, this deduction will likely reduce your taxable income enough that you owe little to no tax on Social Security for the next 4 years. If your combined retirement income is above those thresholds from pensions, investments, or part-time work, you could still face taxes on your benefits, deduction or not. And let's be clear, beyond 2028, unless something changes, taxes on Social Security are scheduled to come roaring back. That means retirees could see hundreds, maybe even thousands of dollars per year in new taxes on the same exact benefits they thought would be tax-free. So think about this. A retiree is receiving $2,000 a month or $24,000 a year who plan on zero tax could suddenly see up to 85% of those benefits taxed again in 2029. That's money that could have been going to groceries, medical bills, or even just enjoying the retirement you worked hard for. This isn't a real fix. It's a short-term band-aid on a long-term problem. So here's what I believe. You've got a 4-year window to get proactive with your tax planning. So if you take advantage of it, you could protect more of your money, not just now, but for years to come. So tax planning tip number 1, you want to consider a Roth conversion. So converting a portion of your traditional IRA or 401k into a Roth IRA now could mean tax-free withdrawals in the future. Doing this while Social Security taxes are temporarily reduced can help you lock in lower taxes for life. Tax planning tip number 2, manage your withdrawals strategically. If you have multiple income sources, pensions, investments, annuities, plan withdrawals to stay under that 75,000, 150,000 threshold. Small changes in timing can make a big difference in your taxable income and keep your Social Security check safe from the IRS. Tax planning tip number 3, work with a CPA or tax strategist. Social Security taxation rules are complicated and they're constantly changing. A good tax strategist, CPA, can run through scenarios, show you what happens when deductions expire, and help you be able to avoid a 2029 tax bomb. Sometimes just one planning session can save you thousands over retirement years. And remember, COLA increases for 2025 are only 2.5%, which means the average retiree is seeing about $50 extra per month. While inflation is still biting hard, that small increase is not going to go too far. The real way to be able to get ahead is to stop unnecessary taxes from eating away at your benefits. This isn't about politics. It's about protecting the money you've earned, because no one else is going to do it for you. And please understand this, the White House headlines are already part of the story. If you're on Social Security, you cannot afford to miss details like this. So number 1, you want to make sure you share this video with every retiree that you know. Let's stop the misinformation. Step number 2, make sure you hit the subscribe button and turn on your notifications. I'll be covering every Social Security Medicare change, so you're always 2 steps ahead of Congress and the IRS. And I look forward to seeing you in the next video. Take care.